The Bank of Spain released their monetary projections earlier this week, talking about this incredible moment in the sun that Spain has had and the Spanish economy has had. How long do you think that can last?
Well, that's not easy to respond. It's certainly behind this, let's say, bright outlook in terms of growth. There are structural factors, or at least I would say a number of elements in the configuration of the European post-COVID economy that help us. But at the same time, it might be elements that are genuinely transitory. I mean, disentangle what is permanent and transitory might prove very difficult. But for instance, there has been a shift in consumer preference in Europe towards leisure after COVID that certainly benefits most countries like Spain that produce more services of that kind, like tourism. And it's also true that non-tourist services are also performing very well in Spain, and this might result of the ability to work now more remotely than in the past, and we are an attractive country for settlement, and that's helping to produce services from Spain to third countries. But even in manufacturing, things are doing better, certainly better than in the rest of Europe, because of, on the one hand, the fact that we are able to produce electricity with cheaper than our neighbors, even 30% cheaper than other large European economies at present, and at the same time, from a more geopolitical perspective in making decisions about where locating factories and other business investments. I mean, I would say that now there is being in the south and being very much in the west of Europe is preferable. All these elements are supporting us. Together, I would say, with policies on digitalization, on climate change, or on migration that are supportive.
You make a really key point, which is that the Spanish economy isn't just really enjoying a lot of the tourism benefits, but really a structural shift from, I would even go further than COVID, but even going back to the financial crisis, the repositioning of the Spanish economy is historic, truly. You've seen that reflected in the bond markets, where credit spreads from Spanish debt relative to German debt have shrunk. Everybody wants a piece of Spanish debt all of a sudden. The criticism of that, however, is the minute that the political situation in France or Germany or Italy or other parts of Europe starts to get better, suddenly that optimism around Spain, the relative optimism, is eliminated. This is something that you talked about in your monetary projections as well. If there is a key risk in terms of that sustainability of outperformance, what is that?
Well, housing is a problem because Spain is benefiting. I mean, overall in Europe there are shortages of labor, particularly of skilled workers. We are competing for this kind of workers globally, and for that, but also low skilled workers. In general, we need to reinforce our labor forces in European countries. Our migration policies are, let's say, conducive to be more attractive for that than other European countries. But of course, housing is becoming a constraint over time, not only from a social dimension, but also from the labor market perspective. And we expect, according to our estimates, that in the years to come, the deficit between the creation of homes or the need for houses for foreigners is going to increase a much faster pace than the production of houses. So in a way, here there is a bottleneck. This is one of the areas in which I think there is a need to work more. But I would say more in generally, we need to enhance the institutional framework, a badly needed reform on on the public administrations in general is needed. Still, there is room to catch up there with the best performance in Europe. And probably on fiscal policy, we need to remain prudent. We need to ensure that there is a long-term planning, and this is very well, this is always requested from investors, that not only your figures in the short run are decent in terms of public finances, but at the same time, you have really a medium long-term view in terms of fiscal sustainability.
Well, in these economic projections, you also talked a lot about not just the uncertainty in terms of the domestic growth outlook, which you've addressed there, but the international growth outlook, a lot of the risk emanating from the United States. Can you just walk me through how you are viewing just some of the rhetoric that's coming out of Washington, D.C. right now? How inflationary could some of these tariffs be from the United States?
Well, they will be primarily inflationary in the United States. In the rest of the world, including Europe, will depend very much on second-round effects and retaliation policies, which are still very difficult to anticipate. I would say that, if anything, what is coming from these trade policies from the United States is uncertainty, extreme uncertainty in terms of the impact on the various economies. In principle, they are inflationary, but at the same time, they might impact negatively on demand and confidence, and in this respect, the net effects in terms of a positive supply shock on inflation and a negative shock on activity, and in turn on inflation exerting downward pressure, is very difficult to go ex ante. So I would say, if anything, the situation has given rise to a very complex and unpredictable environment.
Well, you just laid out the very issue that I think everyone in the markets and, of course, at some of the various central banks in Europe and around the world are facing, which is ultimately, is it inflationary or disinflationary? Is the primary concern an uptick of inflation, or is the primary concern a hit to growth?
We don't know. We don't know. We have to be humble. We have to be humble because these shocks are really unprecedented in terms of size and scope. At the same time, the transmission mechanism depends on second order and behaviors which are very difficult to anticipate. So I think that from a monetary policy point of view, an economic perspective, the key word is uncertainty, and we have to. And it's a kind of this is important. It's not the kind of uncertainty we faced during the COVID, for instance. That was very difficult, very complex, but it was very clearly identified a very bad scenario looking forward that need to be neutralized as soon as possible with very decisive policies. This is a more what we economists label as Nantian uncertainty, uncertainty that is diffused, somewhat blurred, with risk scenarios that all of a sudden could become part of the central scenario or not, or difficult to weight the different elements. And when you face this kind of uncertainty, the reaction sometimes is to be cautious and trying to gather as much as possible information and to be probably more than ever data dependent and keep options open.
So in keeping those options open, though, it's quite clear that the ECB is still very much on a cutting path with the uncertainty to provide that sort of safety and even just to come out of that restrictive territory. Does that create space for some sort of policy misstep? And I ask this in the context of this time we saw this in the first Trump administration when the trade wars first came about. You saw global central banks obviously the Federal Reserve, but right here in Europe as well, talking about insurance rate cuts. Is that the way to be thinking about the ECB's approach to specifically in response to the trade war out of the U.S.?
As I said, I mean, we are not. First, I would say the first point I would like to make is we are now far less restrictive than we were a few months ago because we have already undertaken a significant correction from previous increase in interest rates. So now we are in a situation which is much closer to normal circumstances, and this has to be acknowledged. And from that, I mean, it's, as I said, at this stage, I would say we have to wait to see exactly all these policies or potential policies and second round effects, how they really materialize in which direction. It's very difficult.
So how?
At this stage to commit to anything.
You talk about waiting. The data comes fairly quickly. It comes every couple of months.
Yeah.
How quickly or how much data do you need to see to make a more sure or more concrete policy decision?
Well, the first thing we need to ensure is that the convergence to our medium-term objective, 2%, is materializing. And still in the next few months, we should see some further decline in the rate of in the inflation on services. This is something which is still is important to examine, I would say, month by month. In addition, we have to see. I mean, we have to see how activity is reacting. I mean, how confidence might be eroded, but we have to see. And at the same time, we have another element that might move in the opposite direction in terms of demand, which is the increase in fiscal in military expenditure in Europe, and in general, I mean, the change in the fiscal policy in Germany, which might prove very sizable, and this also may have an impact, in this case, positive one in aggregate demand, but also may imply, in a way or another, inflationary pressures from the fiscal side. It's not clear, but this is a further element of uncertainty, which in a way has been produced as a result of this new environment, context created by the Trump administration. So there are quite a number of elements to wait and to examine that might move in opposite directions. That's the reason why it's very difficult to ex ante commit to anything.
It certainly is a tricky situation, I think, for everyone. But that's being reflected, to your point, that the potential inflationary impulse, I should say, from the German government. You're seeing it show up in the German Bund yields, for example. Is it enough? If we do get the full, I'm going to put a number on it, the 500 billion euros that is expected, or at least promised, from the German government, if that does ultimately hit the European economy in a positive way, is that enough? Could that be enough to counteract any sort of growth hit from the United States? I can appreciate that it's early to make that call, but does that have the potential to do that?
I would say that this change to fiscal policy in Germany is certainly material. So how much may compensate other shocks that might move in the opposite direction is very difficult to say ex ante. But I think the point we have to make is that it's a significant change, and let's say, I would say, marks a different with previous policies on the fiscal front in Germany, no doubt.
So you talk about both the U.S. growth story and the German story, not to mention the other governments around Europe, including Spain's, that is looking to spend on the defense space as well, among other infrastructure projects. Because of the uncertainty you're talking about, does it make sense to take a breath and pause for a meeting? Is that something that's on the cards?
Depends on the information we are going to gather from here to the April meeting. I mean, it's still too early to say. I mean, I think that I would say that when we say, I mean, consistently in public, that we keep all optionality, that genuinely data dependent. I mean, this is genuinely that way. I mean, we really have to wait until the meeting and to gather as many informational elements and pieces of analysis as possible in order to be able to try to reduce this uncertainty, or at least to clarify a number of issues. this might happen or not, but it's certainly meeting by meeting decision making, which requires a lot of prior examination of the information until the very last moment.
But Governor Escriva, you can understand from the public's point of view and even from the financial markets point of view that they're trying to understand that decision-making process simply because they know about all the risks that you've just laid out. But I think the question here is also whether or not, simply because we've seen elements of this in the past, whether a policy misstep is in the offing simply because of the inflationary risks that you've just outlined. I think the concern here, though, is that perhaps the ECB is heading to neutral too quickly, and if that's a problem. Is it fair to even ask that question, whether the ECB is still heading to neutral? Is that still the goal?
Well, the concept of neutrality is a diffused one. I mean, I wouldn't, in a way, when we examined what should be the appropriate monetary policy stance at every moment, this require an examination of quite a number of elements of the environment, of the economic environment, and whether this implies or not to be in a neutral, completely neutral position, I think is not the way I would approach it. First, second, what we should convey to the general public is that we normally work under a centralized scenario with the projections over the next 2 or 3 years. This is our anchor for our decisions, but sometimes the centralized scenario is less likely to materialize, or the likelihood to be attached to it is sometimes larger, sometimes is not as large as we would like, because the uncertainty and the risk to the centralized scenario is very significant. I would say this is precisely the current situation in which the risks to the centralized scenario on both directions are larger than normally. And in a way, I know that sometimes it's not easy for us to recognize the limits of our capacity to predict the future, but it's that way. I mean, the environment in which we have to make decisions is that way. And it's honest, I would say, and humble to tell to the public, look, now the situation is particularly complex, and that's the reason we have to really avoid committing ourselves to any future path.
The logic makes absolute sense, but I think the kind of thinking around, I mean, you mentioned it yourself. The ECB has already come quite far off of being extremely restrictive and has pulled that right back. You talked about the fact that the idea of neutral being fairly a hazy, perhaps, kind of concept, but it does still feel like, or at least the messaging that the public has gotten from the ECB, is that we are still too far into restrictive territory, despite the inflationary concerns that you're not just seeing, by the way, from potential defense spending, but from the markets as well, and these giant moves in yields. Are the markets tightening financial conditions enough to make that perhaps dovish view possible?
I understand that the potential beauty of having in mind a neutral interest rate, what you aspire to reach at a certain point in time. But the problem is, first, that this level of neutral rate is surrounded, whatever estimate you make, by substantial uncertainty. So such an anchor is not so obvious, first. And second, even if were to be an anchor with uncertainty, we need to examine carefully at each point whether we are in an economic environment, in conditions and state of the economy that is really that really requires these more or less normal conditions. These two elements are not easy at all. And I think that our responsibility is to basically convey and be transparent as much as possible about the limits in which we make decisions. And at the same time, I think and I think the experience over the last few years is a good example. I mean, we tend to make right decisions, and in that respect, which probably is most relevant at this stage is that inflationary expectations remain very much anchored around the 2%, and this is in a way a reflection of the credibility of the monetary policy now and the expectation about the monetary policy future.
Are you watching the markets, the bond market move specifically?
Well, we watch everything, and we watch everything, that's right. Yeah.
So does the momentum of the yield move in the German bond market worry you?
Well, it's the expected move. I mean, when you really announce a change in policy that is going to imply over a number of years, 1 decade, if I remember correctly, a significant increase in the debt level, public debt of the German government, I mean, it's logical that the market increases the level of the long-term interest rate somewhat. It's not a dramatic increase. It's something that I would say responds more or less to the announcement.
How does that impact the calculus around rate cuts, though? Simply because I say this, and I understand that you are, of course, still collecting the data, but again, do the markets and what the markets are pricing in the bond market and the currency market, by the way, affect the financial conditions that the ECB is going to be monitoring in 3 weeks' time?
I would say that what is going on in the bond market in Europe, it doesn't impact us or in the way we behave very directly. It's more, I mean, it's relevant in terms of the assessment of the global financial conditions in Europe, but there are so many other elements that play also a role there that there is not a direct link with our policy.
So you talk about the fact that you're still monitoring the data. What kind of data would change your mind? What kind of data for you is the game changer, specifically when you've already spoken about services data, of course, being something that you're monitoring? What to you would justify a potential pause or a cut or a hike? What data for you is the game changer?
Well, certainly services data, price services for the months to come is an important piece of information, but also all the indications about the resilience or not of the European economy against a background of confidence shocks and elements that might erode confidence is also something that we have to examine very carefully. So, but in a situation of uncertainty or high uncertainty as the one we are experiencing now, is more important than ever the value of hard data. So we can make predictions, but the predictions that we may produce at this stage are surrounded by such an uncertainty because of the nature of the shocks and elements and the very much unknowns that really the value of hard data, of data reflecting exactly what is going on in terms of inflation, actual inflation or activity, is of most valuable at this stage.
Let's talk about one of your other roles here in the banking supervisory capacity as well. You talked about this massive amount of defense spending that could be a positive tailwind for the European economy. There are still a lot of concerns about how European banks can help facilitate that process. Talk to us a little bit about what the future of that relationship looks like.
Well, Europe is a very bankerized financial system, so banks should play a role in a way or another to financing all this investment, primarily the private one, I would say, of course. But it's clear that because of the nature of this investment, long-term, surrounded by uncertainty in terms of profitability, for instance, of the firms involved, the fact that they need to materialize over longer horizons, this is more for capital markets. And I think once again, it's very important that Europe develops deep capital markets, specialized one, in order to cater for this kind of investments. And what banks might do in financing is of limited scope, I would say, although probably they should do more than in the past.
Bloomberg has reported that you have sent a letter alongside the banks of Spain, alongside banks of France, Italy, and Germany to the European Commission about simplifying some of the banking rules. What does that entail? What does that include? Well,
it's not a rumor. It's true. I mean, we did it, and we thought that while reinforcing the idea that it's important that Basel III is fully completed and we are not talking about, by no means, about deregulation of any kind, we feel that there is a need at this stage, after a number of years, to review all the norms and supervisory procedures under the so-called level 1, 2, and 3, including guidelines, and to have an holistic view about the room for simplifying all these set of
But give us some examples. What does that look like? Are we talking about inspections? Are we talking about the collateral? Give us an example.
We're talking primarily about the pieces of legislation at different levels that sometimes might overlap, might give rise to a too overly complex environment for banks. So simplification is the word we have used. So we see room for simplification, and I think this requires an holistic view, and what we suggest is that the Commission takes the lead in doing so with a group of experts that look at all the elements involved in the various bodies involved in Europe.
But does that include rules like collateral, for example, specifically around defense spending?
I haven't thought precisely about this, certainly not when we wrote down the letter. It's primarily all has to do with requirements for capital, requirement for supervision of bank resolution is also an element which should be involved. Even macroprudential legislation. I mean, there are quite different, let's say, layers of activity and legislation that operate simultaneously, and there is a need to, in a holistic manner, in a global manner, to look into it and to see the room for simplification.
The United States has been, or is looking to, decrease their capital requirements. It's something that the Swiss Central Bank, for example, or Swiss National Bank has said they're not going to be following suit.
No.
Are you arguing here to follow suit on that delay?
No. Simplification doesn't mean by any means lower capital or deregulation.
But even to delay the Basel III requirements, to compete with the U.S.?
I think Europe should not do that. I think Europe should stick to the path and that we have decided ourselves, and we should not be pushed by the decision in other jurisdictions, by no means.
But does that hurt competitiveness for European banks?
Not necessarily. Not necessarily. I think that you take a long-term view, a solid banking system, a banking which is well supervised, well capitalized, from a medium long-term perspective, is superior to a banking system that doesn't feature such elements. And the past have shown many times that example.